Today we're going to be talking about grandparent-owned 529 accounts. Now the rules are changing in 2023 to make them even better. I mean, they've already been one of the most advantageous ways to save for college for students, mainly because when you look at the FAFSA calculation, they take the assets and income of the parent into consideration, the assets and income of the student into consideration, but they never look at the assets of or income of the grandparent. So if the grandparent owns these 529 accounts, they are almost invisible for financial aid purposes. However, there has been a major issue historically with these grandparent-owned 529 accounts. It's actually little known. So while they never show up as an asset for purposes of the FAFSA calculation, they can show up as income of the student at some point. So the way it works is, if distributions are taken from a grandparent 529 plan, in the year that distribution takes place, the amount of the income actually counts as income of the student in that determination year, which hurts badly. Because when you look at all the different categories, assets and income of the parent, assets and income of the student, income of the student is by far the worst penalized category that counts the most against financial aid. Currently, there is a threshold within this student income category that any income below $7,000 doesn't count against the calculation. However, income above $7,000 counts 50% against the EFC, or expected family contribution, which counts against the financial aid award. So if you look at a grandparent that distributes $30,000 for a student from a 529 account in a given year, while it doesn't trigger anything initially, in that determination year, it's looked at as the student had $30,000 worth of income. So essentially the first $7,000 is shielded, but the other essentially almost $23,000 is now on the table, which could hurt them about $11,000 in their financial aid award 2 years down the road. The reason why I say 2 years down the road is because the FAFSA calculation has a 2-year look back period for purposes of income. So if a student is applying for financial aid, let's say fall of 2022, they are looking at actually the 2020 income of the student and the parent going back essentially 2 years. So that's why people don't find out about this mistake and essentially 2 years later. Up until now, the workaround for this is when we have a grandparent that has a 529 account, if the student is actually eligible for need-based financial aid, we may advise that grandparent to not make any distributions from that account until the spring of their sophomore year, because the timing of that, once they're in the spring of their sophomore year, 2 years forward, when they're applying for FAFSA, they've already graduated at that point. So then you're kind of free and clear. So even though distributions are coming from that grandparent 529, the income never shows up because of the 2-year look back. A quick planning note, all of this only matters if the student actually qualifies for need-based financial aid through the parent's FAFSA application. If the student already does not qualify for any type of need-based financial aid, then you can just take distributions from these grandparent 529s as you please. It's not going to affect the aid because there is no aid. The new rules that are going into place 2023 solve all these problems. It actually made these grandparent 529 accounts even better. So starting in years 2023, any distributions that come out of these 529 accounts no longer count as income of the student. So now they are 100% free and clear of FAFSA consideration. There can also be tax benefits of the grandparents for making contributions to these 529 accounts on behalf of the grandchildren, but it varies from state to state. Like in New York State, they offer a state tax deduction for $5,000 for single filers, $10,000 for married filing joint. This is not a federal tax deduction, it's a state tax deduction. Some states have them, some states do not, so you just have to do your homework. A common question is, what happens if my grandchild decides not to go to college? So I made all these contributions to this 529 account, now what can I use it for? So there's a few options here. So the first option is you can always change the beneficiary on that account to another grandchild, another family member, whoever you want. So you can just shift that balance over to someone else. The other option is you could just take a distribution of the account balance. Now, if it's not being used for qualified college expenses, when you take that final distribution, the amount that you put in, your contributions, are returned to you tax and penalty free. It's the earnings piece. Whatever that account earned, the earnings piece, if it's not used for a qualified expense, you have to pay ordinary income tax on it and a 10% penalty. In 2017, they also opened up another feature for these 529 accounts, which is distributions for K through 12 expenses, which was otherwise not available. Previously, it was just for college, but they opened this up saying up to $10,000 per year can be distributed as accounts for K through 12 expenses. Now you have to be careful here because the federal government came out and recognized this new rule, but many states did not. So states do not necessarily have to adhere to the changes that the federal government makes. So New York State is unfortunately one of those exceptions. While the federal recognizes that $10,000 per year is a qualified expense for K through 12, New York does not. So if it's considered a non-qualified distribution, you have to pay state tax on the earnings, and they also make you recapture any tax deduction you receive for the contributions to the account. So it's a double whammy, but this does vary state by state. So again, you just have to do your homework. If you have any questions on this 529 saving strategy, please feel free to reach out to me at moneysmartboard.com. Thank you.